Our next presenter there's only two left. His name is John Seville. He's the CEO and founder of Acorn Wealth Corporation. Acorn Wealth Corporation is one of the leading stock trading academics in North America that have over the last 7 years worked with thousands of investors to help educate, train, and mentor individuals on how to effectively manage their own money. John, along with his team, they spent the last 11 years mastering the art of technical analysis as a method of finding trading opportunities in the North American markets using some very unique techniques. Using such techniques, John and the other senior traders at Acorn Wealth were able to identify exit points on the market prior to major breakdowns, such as in 2008 and in months preceding the European Union crisis. Without further ado, I'm going to go ahead and bring John to the presentation screen, and you guys are welcome and enjoy.
Okay, good evening or good morning, depending on where in the world you are. Thanks so much, Chris, for the good introduction. What a wonderful event, and thank you for having us. The current market conditions are the perfect time to be talking about what we're discussing today. What I'd like to talk to you about today is about trading on targets and using the smart money as an indication of where the market's going. So hopefully everyone can see my screen. If I can just do a quick check. Can everyone see that okay? Terrific. Okay. So a quick disclaimer. Obviously, talking about stock trading does have risk involved, but that's nothing new that we'll teach you today. And a quick introduction as to who we are. As Chris was saying, we were founded in 2007 by a small group of traders, myself included, and we were focused mostly on the technical side of the market. So looking at where price was going as an indication of what the true story underlying the events was. And using the smart money techniques that we're going to talk about today, we saw key indications that the market was going to crash in 2008, on June 6th to be exact, and as well as the EU crisis. So having said that, let's have a quick chat about what the backdrop of the current economy is. If you have a look around at what most of the news is saying and where the money is coming from, obviously central banks have been pumping into the economy for the last, God knows how long, but most recently mostly into the economy with no end in sight. We've bailed out most of the major banks. The smart money is getting richer. But what about individuals? How many people are better off? So the question is, has the rally that we've seen in the market over the last 12 months really been based on true economic activity, or is it just another bubble? And when we entered into 2014, I don't know how many people follow articles such as Stock Twits and things like that, but I was reading going into January that 96% of all of the traders on Stock Twits were bullish, which scared the hell out of me, because we know what that generally brings. And when you have optimism amongst all the market players, all the traders as well, that's usually when things start getting scary. If you look at the rally, in fact, over the last 12 months, where does that come from? It's come from new technologies like cloud computing, Yelp, Amazon, blah, 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 Facebook, Twitter, all this stuff that have been driving the market. But then you start looking at the, the brick and mortar things, the things that the darling investments everyone was looking at, such as the emerging markets, and that's completely wet the bed. Right? You look at the Dow Jones Transport Index, for example, it's not doing well. But if you look at the sectors that are, it's healthcare, it's technology, and utilities. Right? You look at the three main sectors that have done the best in the last little while, it's healthcare, tech, and utilities. So the two most speculative indexes and the most safety index. So the market's being driven right now by punters and people that are afraid of things like transports, brick and mortar operations. What does that say to you? So what is your plan in this year as the Fed continues its tapering, whenever that starts to happen? And most importantly, what did you learn from 2008? Because it's really easy to quickly forget how painful that was, how many people I spoke to that lost half their life savings because they didn't know what things to look for. They didn't know what questions to ask. And everyone said, I'll never do that again. But what have you changed? What big differences have you made that would protect you from that ever happening again? So with that being said, I'll also throw the question out to you. What type of investor are you? And feel free to throw it into the chat box because it's always a very significantly different answer, I find, depending on the group. But I'm sure most of you are educated investors. But what type of investor? You've got your Warren Buffett type, the long-term guy. There's less and less of these days usually. But these are the Titanics, right? You can't make 5-second decisions. You're a big guy. You're looking at the long-term picture. And it takes a while to shift the direction of where you're going because you're looking at the macros, you're looking at the story, you're looking at the company's management. On your other end, you've got the complete opposite, which is the guy who's a day trader who really doesn't even care what the company does, much less what their fundamentals are, because they're just looking to get in and out within, say, 10 seconds or 10 minutes and whatnot. And then in between, you've got your swing trader. And that's where I preference most of my trades, is a marriage between the two of these, mostly because of why I trade, which is to have free time. And the swing trade, of course, is looking at a little bit of a blend, making sure the company's not going to go bankrupt tomorrow, but wanting to get in and out within a few weeks to capitalize on the quickest, potentially easiest profit there is to gain. And then your investment objectives. This is the third part in building a trade plan. Now, these are cliche. You see these in every presentation you go to. I was looking at buying land in Nicaragua a couple of years ago, and I think I saw the same 6 pictures. Grandparents kissing their kids and Ferraris and things. So I apologize for the cliche nature, but it is important to think about why you want to trade, because for everyone that I've taught in the last 7 years, yeah, people want to make money, but that's not why you trade. It's what you want to do with your money. No one likes trading just because they like pretty charts and things like that. They want to have free time. They want to work from home. They want to give their boss the kick, and that's what you have to think about, because at the end of the day, as I was hearing Tom speak about, you're going to have failures. You're going to have testing times. And if you don't remember why you're doing this, what the emotional, need is that you're really trying to fill, then it's hard to stay on track. So it's always important to think about this, because this will ultimately lead into the next part, which is how you make your decisions. So how do you make your decisions? Is it the news? Is it tips from friends? Is it how you're feeling that day? Is it financial advisors? Is it things you're familiar with? This is, by the way, a picture of Vancouver. So despite my Australian accent, this is actually where I live. This is where I'm talking to you from right now. Pretty much exactly there. So yeah, how do you make your decisions? What's the process you go through if you were to sit down right now and decide what stocks you were going to buy tomorrow? So mostly how people make their decisions is through those 4 things, which is usually emotional. And what emotions do is they lead to mistakes. Just think about this before I bring up these bullet points, in fact. Think about this very fact. They estimate that 95% of traders lose money. 95%. So if you think about it this way, if you were just to throw darts at a dartboard and pick stocks that way, you've got basically a 50-50 chance of making money, right? Stock's going to go up or down. So with a 50-50 chance of making money, why do 95% of people lose? Isn't that a kind of an obscure statistic? I would argue that the reason why 95% of people lose is because despite having 50-50 odds, as much as throwing a dart, people have emotions in common, which is a fundamental problem of making money. And that's why they fail to limit losses. They average down. They buy into emotion. They believe in public information. They sell on pullbacks. And they take too much risk. Classic example, stock goes up 10%, you thought you should have bought it yesterday, you kick yourself because you see it up 10%, and you say, all right, well, I'm going to get into it anyway. I'm not going to punish myself and not take advantage of this rally. You buy it, all of a sudden it drops 10% again, and you kick yourself and say, yeah, I knew I shouldn't have got in, I knew I should have bought it the day before, okay, now I'll get out. Then it goes up 50%. And you're constantly feeling like the market's looking over your shoulder as if it's ready to do exactly the opposite of what you do when you do it. And this is emotional decision making. Again, why 95% of people lose money? Because they invest emotionally and they lack a strategy. But again, it's not surprising when every single day this is what's being put in front of you. Noise, noise, and more noise. Things, misinformation, things to distract you. So let's try and just dissect that noise and cut it out. And let's come back to the real tangible parts of how you want to make money as a business. Because this is important. If you sat down right now and I gave you, a crayon in this example, if I gave you a crayon and said, hey, tell me exactly what you're looking for if you were to buy something tomorrow. And you should know this, because you do this probably with all your other purchasing decisions, right? You're going to go and buy a car, and you had 2 kids and a wife, or 2 kids and a husband, depending on what side you sit on. And you lived in the middle of a cold climate. You'd say, okay, well, I need snow tires. I need 4 seats at least. I maybe need ski racks on the roof when we go skiing. I need all these things, and hey, my budget's 40 grand. Right now, if you went out shopping for this car and came back with a 2-seat convertible with slick tires, you probably wouldn't have that family for very long. By the way, I do know somebody who did this exact example, so I'm talking from experience. You have this list, and you go out and you're ruthless in making sure you get the right deal. If you go to the first dealership and he asks for 60 grand for that car, you move on. But people don't do that in the stock market. They don't really know what they're shopping for. They don't have this type of checklist. They're really just going by this hope that today's their lucky day and that's going to lead them in the right direction. But if you were to sit down and get that out of the way and put down a list, what would it be? What exactly would the chart look like? And once you found it, what would the conditions be? What sector? What P to E ratio? Are the insiders buying? And if so, how soon? What price? All these types of things. And of course, I'm going to talk to you a little bit more about what you should be looking for, but I would start by asking these questions. Most investors don't know the answers to this. They might have a general idea, but not specifics. And if they do, they don't usually stick to them. And the problem with that is if you don't know where you're going, any road will take you there. So I've met hundreds of well-educated traders, people who've traded 5, 10 years. It's the thing they want to replace their income with. They've bought every book under the sun. But despite being well-educated, they're still not making money because they just don't have a plan. They don't know what they're doing. So the obvious question to ask is, all right, well, that's all well and good, John. What plan should we have? So when we started Acorn 7 years ago, which was 5 years after I started trading, I thought that the most prudent question to ask was, well, if we're going to develop a strategy that's going to work, because there's hundreds of strategies that do, which is going to be the best one? Which one should we stick to, and what noise should we ignore? So I thought the best question to start out asking was, well, who controls the market? The big money, the money that's making the most amount of profit, how do they make their decisions? So if you were asked that question, I would say that volume controls the market, because volume dictates price, right? So who controls the volume? I would say the smart money does. In fact, if this is probably nothing new to you, but 70 to 80% of every single stock that's bought and sold each day is done by algorithms, done by computers that have nothing to do with a decision being made, nothing to do with who runs the company, just purely pattern-driven or process-driven decisions that makes up 70 to 80% of the volume. And billions of dollars are made daily by these trading computers. Now, this doesn't mean that, we'll say, who is the smart money? Well, Goldman Sachs, JP Morgan, the high-frequency trading firms, all these guys. Now, does that mean that they have 70 to 80% of the money? No. But think of it this way. If there is 100 of us sitting in a room and we all had $1,000, right, and we decided to buy company XYZ, how much, and we held it, how much volume would that be? It'd be $100,000, right? 100 people with $1,000, we buy it, we hold it, it's $100,000 worth of volume. But what about, Jimmy in the next room, who's also got $1,000, and he's designed an algorithm to buy and sell, and he pushes start in the morning, and his algorithm buys and sells the same company XYZ with his $1,000, and he does it 100 times. But he's buying and selling 100 times, so how much volume would that be? Well, that'd be 100 times 1,000 times 2 for the buy and sell. So he'd make up $200,000 worth of volume with his 1,000. So one guy is now 200% more powerful in terms of the volume than 100 people with the same amount of money. And this is how the smart money whips the market, like a death of 1,000 cuts, or if you want to think of it this way, it's the mouse casting the shadow of an elephant. And these are very, very powerful forces. You look at the flash crash of May 6, 2010, market plunged. What would normally take a year for the market to rally took 30 minutes to destroy because of this domino effect. Well, before we go into that, let me think of another example. What about the NASDAQ crash being turned off for a day last year? And what excuse did they give us? That someone tripped over the power cord? Are you kidding? You know, the NASDAQ that houses most of the high technology companies got shut down for a power-related issue? I don't think so. But this is what you've said, and this is what they assume you will believe, because keeping you confused is how the smart money continues to make money. Why wouldn't they? I mean, if you've got $1 billion worth of Apple and you're highly confident that it's going to crash, what's the first thing you do? Convince $1 billion worth of people that it's the best time to buy. That's how money's made. The market isn't there to help you. The market isn't there to make you money. It's not a charity. It's a business. And the way people make money in the market is by somebody else losing. So you have to figure out what side you sit on, and you have to realize that in order to have an edge, you have to figure out what the people with an edge are doing. And that's why we start to look at the smart money, because these forces are predictable. They're not working hard. They're using computers to do their job. And these computers are making the same decision millions of times over and following the same rules again and again and again. And when something happens, if it's repeatable, it's reverse engineerable. Okay? Now, we're not looking to try and compete with these guys. They've got bigger pockets and far more resources than we could ever hope to have. But what we can do is, if we can detect when they buy and how they buy, because they are buying with a lot of money, we can tag along for a little bit of the ride. As long as we can take the greed factor out, we can take a little chunk of their action, because there's enough people that don't know, right? So how do we reverse engineer that? How do we get to that point? Well, when you're creating a business, right, when you're creating a plan, you need to start with a thesis. You know, grade 10 physics taught me that. You need to have an idea that you're going to drive. So the first type of true statement that we need to understand, that everything builds off, is to understand what the core DNA of the stock market is. How does it move? Right? That's a fairly important question to ask, right? How does the stock market move? Well, the first thing is to understand that I believe that a stock never changes direction unless it hits one of these three things: horizontal support, trend line resistance, which is diagonal usually, or moving averages. If it doesn't hit one of these things, it doesn't change direction. So your first job is to figure out why or what one of these things a stock reacts to. So, because in essence, algorithms don't see this. They don't see a chart. They see this. They see levels. They see decision points. And you want to break down how to make money as a trader to a very, very simple strategy. The job of a trader, if you know where these lines are, is to simply buy as soon as we hit one and sell before we hit the next. That's called the free money. It's free money because if we assume that what I said before is true, that a stock will not change direction unless it hits one of these things, then if there's nothing in between here and here, then that's free. That's that free room that if the stock bounces, it will go up to the next line at least. And when it hits there, that's the question point. That's what we don't know, is whether it will bounce back down or go further. So the free money, the easy money, is simply to buy here and sell here. And if that distance represents 5, 6, 7, 8%, and we can do that 3 or 4 times a month, we're looking good. Of course, the next question, though, is, well, which one of these lines do we buy at? Right? Do we buy at that line, or do we wait for it to go lower, or do we wait for it to go higher and short it? And so this comes now back to understanding targets, understanding where the smart money plays its role. Now, let's think back at the flash crash of May 6, 2010. This wasn't a big surprise, guys. I mean, the market had already had a pretty precipitous drop in January, February, and rallied from this huge drop straight up into a massive rally. And it created a shelf of support up at 1180, and then as soon as it broke it, that was the catalyst for this apparent anonymous large gentleman that apparently pushed the B button instead of the M button, if you believe that. And where did it fall to? The exact same level. You know, how valuable would it have been to have bought everything with a ticker symbol at that level? Could you have predicted it? Absolutely. That was where it was. The key is now to start learning from this and reverse engineering how to detect this fingerprint so that we can buy the next time we see it, right? Or anticipate where that will be. So the first step in doing that is to find, find the strong level. So how do we start determining what that fingerprint will be? So skip back here a second. Okay, so the way I always like to think about things is I always like to understand the process of a strategy, the why factor. I sat across from a trader that I'm working with one-on-one at the moment, and the first time I sat with him was about 6 months ago, and he's trading, $1 million plus in his account. He retired as a senior engineer about 5 years ago. He decided that trading was going to be how he would fill his needs. And he'd spent tons of money learning all of the, the whiz-bang buzzwords of spinning tops and harami candles and blah, blah, blah. But, so every time I gave him a pattern, I said, well, what's a rising wedge? Okay, it's bearish. What's a triple top? What's a double top? Oh, that's bearish. What's a descending triangle? That's bullish. Okay, great. You're very well book-smarted. But could you please tell me why? Why is an ascending triangle bullish, and why is a rising wedge bearish? Explain to me why that is the case. He didn't know. Because basically he knew how to parrot back to me what the buzzwords meant, but he didn't understand the reason why that actually happened. So he wasn't an engineer of his business of trading. He was just a victim of too much knowledge. And that's why he wasn't making consistent money. So let's come back to again, the bare bones, as rudimentary as this might be. Let's think back to what we're trying to detect here. We're trying to detect the smart money. It's algorithmic buying. So how does a computer buy? A computer buys because it's told to. Not because it's had a fight with its wife and it's angry, or that it's late to work and bought at the wrong time. It buys because 1 equals 1, and that's a buy signal. So when we're trying to detect computerized buying, what we're looking for is a reaction. We're not looking for this. Not looking for this nice kind of gradual slope up. We're actually looking for a sharp, aggressive rebound. That's the first thing we need to find. Where has the stock dropped 10, 20% and then almost instantly hit some kind of magical floor and gone straight back up? So that's the first question. How much did it drop? How quick did it drop? And then how quickly and how much did it go back up the other way? If we can detect this, that's the first step. The second step is then to ask how fresh the level is. Now, when I first started trading 12 years ago, I thought that logically, if you see a stock that has bounced 1, 2, 3 times, 4 times maybe, then this was a pretty strong level. And most investors, when they start out, believe this too. The more times the level's been hit, the better. But it's wrong. The more times the level's been hit, the weaker it becomes. And the why behind that is very similar to why a coach in the Super Bowl doesn't throw a Hail Mary pass 6 times in a row. And if you want to make that analogy, if I can make that analogy clearer, an Australian explaining the American football to you, if that sounds weird. When I first watched football, I was confused to hell with it. I couldn't understand why players were running in opposite directions, why where they were throwing the ball. It didn't make any sense. But the more and more I watched it, I realized that this was actually a systematic, calculated pattern that this chaos was organized with. But it wasn't one pattern, it was a playbook of maybe 100 different types of plays where the players knew exactly where to go. And I likened this almost immediately to the stock market, right? That the coach with the playbook is the smart money. It's the market makers. And they're looking through these 100 different plays, head and shoulders, double top, blah, 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 and they're saying, which one do we play now? And so when you look at a stock and you see chaos, what you're actually seeing is just a play-by-play of all these patterns being orchestrated. And the reason they don't play the same play again and again and again is because if you did, it would be easily defendable. People would figure it out. And once again, the market isn't there to help you. It's there to make money from you. Right? The smart money needs to make money by you losing. So that as soon as you figure it out, they switch the play. So the best time to buy a stock to detect the pattern is the first time that it happens again. Because that's the highest probability of you making money. So with all of this being said, I'm going to give you a little test. So get your chat box ready. If this was a chart, right, if we're looking at this as a hypothetical stock, and I was to ask you, okay, well, where would be the perfect time to buy? Would it be, I'll have to draw this on, would it be here at A? Would you wait for it to go down there and go long? Would it be B? Would you buy it right now? Would you short, bet against it at C? Or would you wait for it to go up to D and short it there? What do you think? Where do you think the highest probability trade is? Now, most people, when I posed this question before, have very, very different answers. And the answer that I would suggest is the correct one is A, shortly followed by D. The reason being is that A is the strongest level because it is fresh, it's only been hit once. It's also the most powerful. It went up 1, 2, 3 levels. D would be the second most powerful because it's also fresh, it's only been hit once, but it only went down 2 levels, which is why it makes it second best. B and C would be nothing that I would ever trade, because while it might make money, it's not the highest probability. This has been hit too many times, 1, 2, 3 times. It's also only had a kind of mediocre performance when it did that. So that's not where the algorithms, that's consolidation. It's the noise. And so I would pose to you that on any given stock, out of every given day, there's only 20%, maybe even 10% of the time throughout a year, is it even worth trading? 80-20 rule, right? And most people compromise this quality because they don't know how to find anything else. They don't know how to find the stock that's best to buy today, so they just stick with what they're comfortable with. I would argue you should be doing different. So let's talk about another question. So again, let's look at the this is an A/B scenario. Let's say you're looking for the perfect short, and you found 2 stocks, one that looks like this, one that looks like that. Which would be the best one to short? In this scenario, I would argue that it is B, because A does not have that kind of algorithmic fingerprint that we're looking for. It kind of just rolled over gradually, which isn't the type of action we're looking for. It also has higher lows. So this, in fact, is more likely to be some kind of ascending triangle or something, but something that's bullish. B, however, lower lows, reaction type of top, algorithmic, and this is where we want to short it. So looking for the smart money, looking for where the money that controls the market's going is key, because no matter how smart you are, the smart money has to agree with you. If you go out and do all the research in the world, you take your MBA, you're a bachelor of every single thing you can get a degree in, and you go out and find that company XYZ is the diamond in the rough, and it's going to go to $50 next year, and it's $5 today, well done. You figured that out. But if the smart money doesn't agree with you yet, and everybody else disagrees with you, then it might still go all the way down to $1 before it goes up to 50. And that's a painful ride. Are you willing to hang on while you lose 80% of your money because you, yes, had the right answer, but you had the wrong timing? Because that's tough, because you're breaking every money management rule there is by doing it. So no matter how much research you do, if the market doesn't agree, you might be right, but still lose money. Because the timing has to be there as well, and the timing comes back to the fingerprint of the smart money. So let's talk about checklist, and this is where it starts to get fun. And by the way, we're going to look at some live examples here in a bit, like Apple, the S&P, what smart money is doing right now. So make sure you stick around for that. But this last bit of theory, before we get to the practical, we need a checklist. Firstly, we've just talked about this. We look for high probability zones defined by a process. Was there previously strong levels of buying? Was it a fresh, strong level of buying? And how much did it go down? How quickly did it turn around? And how fast did it go back up? If we can compound that with the added advantage of being searching for something in a strong sector, in a strong market, now we're cooking with gas. And when I say a strong sector in a strong market, I don't mean looking up on FinViz, what was the strongest sector this week. That doesn't count. That's reacting. That's why 95% of people lose, because they're always looking back. What you need to be doing is looking forward. If the strongest sector was XYZ, and as a result it's driven straight up and headed into its key smart money resistance level, then that is now bullish. So when people talk about is the market bullish or bearish, I rephrase that. Say it differently. Is the market at resistance or support? Because a market that is at resistance has probably been really bullish recently, but is now set to potentially drop back. So ask yourself this when you draw your lines on your charts, when you analyze the markets, ask that. Is the market at support or resistance? If it's at support, let's scan for longs. If it's at resistance, let's scan for shorts. And if it breaks through that resistance, 5 minutes later, change your mind, switch, go back to longs. And that kind of, a reactionary discipline when it comes to technical analysis is what will make you money. So let's look at an example of that. This is a fantastic example, by the way, of everything we've just talked about. I came across it just scanning through the market a few months ago. This is a company called Acorn. Now, this isn't a small company. It's not a huge company, but it's not small either. They trade about $30 million plus dollar value of volume a day. Now, if you look back into April 2012, have a look at this. It came straight down, hit this price of $24.50, and rocketed right up to $28.50. Huge move, and then came straight back down as well. So straight away, based on what we've talked about, this would be what I call the fingerprint. This would be kind of where I would almost go into my brokerage account back in April and say, you know what, if this comes anywhere close to $24.50 again, just buy it. And that's exactly what the algorithms do. The next time it came back down to $24.50 was over here. It actually gapped down, opened from 28, opened at $24.50 the next day, and the second that it hit that price, it rallied straight back up to 28 bucks. 20% rally intraday. Now you might notice as we look at that, hey, this has happened actually on the top too, up at 32 bucks. We're going to come back to that. It's also hit this here at 26.50. See how these all look similar in terms of what I've just been talking about? So let's have a look at that. There's your level, 26.50, straight up, 32. And lo and behold, September 2013, same level, straight up to 29.50. There's a $3 rally on a $26 stock, so over 10%. And then once more, the third time here. And this brings us to January, just a few weeks ago. And you see it hit this, and what's next? I hope you're all curious. I found this fascinating to watch. Straight up. And where it went to was exactly the same place that it went to before, 32 bucks and change, which is where if you were long, you would have immediately been out by setting your targets, coming back to that keyword, selling it, buying it by telling your brokerage account, if the stock ever goes to this price, buy it for me. Don't text me, don't email me, don't ask me a question, just buy it because that's the smart money zone. And when it goes up to XYZ, sell it. And it did. It went up to 32 bucks, hit the smart money sell zone where you take profit, and at the same time, hit the smart money short zone where you basically short the hell out of it. And it went straight down from 32 all the way back to 28. Now, again, if this was some kind of penny stock out of China, I might understand this kind of movement and be, second guessing it. But this isn't. It's $30 million plus a day. Think about it this way. If you were to take a 100-ton truck going at 100 kilometers or miles per hour down a highway, and you were to stop it instantly, turn it 180 degrees and send it immediately back in the direction at the exact same speed, how much power that takes? So in the stock market, I would argue that it would take the truck power 20 to 80% of the volume would perhaps control. What is that again? The smart money. So once you've got this, once you know how to find these levels, we still want to go further. We still want to find additional things that give us more probability. So we start to look for signs of overbought and over, CCI, RSI. Don't use your momentum indicators. They won't work here. Don't use your moving averages and blah, blah, blah. They will not work on an oscillating stock. Use your oscillating indicators. Look for heavy levels of volume. Finally, then with price action tools such as Bollinger Bands, look for the fact that the stock is outside them. Outside them. And then finally, if you want to get really kind of particular about it and really refine this even further, now increase the probability by using chart patterns. Go to your daily, hourly, and weekly charts and look at what pattern the stock is on all three. And if you can find that if you're looking for a long, and you can find that as the stock hits that smart money buy zone, it's in a falling wedge, bullish, great. If you're looking for a short, and you find that as it approaches the smart money trend line, and it's also in fact in a head and shoulders pattern, great. But that's where you finally increase your odds. There's 130 odd patterns out there. The trick is knowing which are the top ones that give you the highest probability, predictability, and profitability. I call it the 3 Ps. And finally, the question you want to ask is, where's the smart money going? Now, I've talked about smart money talking in respect to previous zones that a stock has rallied or fell from. Now, that's kind of looking at where the fingerprint is, but you also want to look at where the what it's doing now. And so, just share this here. I'm going to give a quick screen share. Let's switch over to our chart. Now, smart money, in terms of how I want to display it to you now, is about understanding what the true drive behind a stock is. So ask yourself this, by most common definitions, what is an uptrend? How do you define an uptrend? Just type it into the chat box. What is an uptrend? That's right. The technical definition of an uptrend is higher highs and higher lows. But is that really true? Question that. If I had a lemonade stand, which it's snowing outside right now in Vancouver, so I wouldn't be opening it today. But if I did have a lemonade stand, and let's say that I sold lemonade for $1 a glass, and I went outside out in freezing cold Vancouver and started selling it, and I sell 1,000 cups, I made $1,000, right? So I come back in, and I sell some at $1.10, I sell some at 90 cents. Those are my highs and lows, but overall the close is $1. And I think, well, geez, business was good today. I'm going to up my prices. So tomorrow I go out there and I say, well, they're $2 now. And I sell 200 cups, some at $2.10, some at $1.90. How much have I made? Now I've made 400. So now I up it again. The third day I say, well, they're $10 a cup. And I sell 1. Do I have higher highs and higher lows? Absolutely. But do I have a growing business? Not at all. So price is not the only thing you need to look at. Price is how they confuse you. Price is how they fool you into breakouts that are fake outs. Price is misleading. What you need to know is, yes, are there higher highs and higher lows, but is volume going up as well? And is volume going up in the right way? Is it going up because every time it jumps up, everyone sells off? Or is volume going up and holding the stock up? So this is the third factor. Is the stock closing in the top half of the range? And if you get all three things happening, price, higher highs and higher lows, volume going up, and high closes in the top half of the range, now you've really got an uptrend. Now the market, the smart money, agrees with you. It is an uptrend. And that's difficult to be able to put all that together. You know, it's relationship data. So I prefer to look at it as an indicator. This is one of the few indicators I do find that are actually very valuable. So as you start to look at money flow, you'll see, now this is Apple, a great example of where you could have found a really easy short. I talked about this in a workshop for those, I think maybe perhaps many of you have seen us talk before about this. In December we did a workshop about Apple, and one of the audience members said, what do you think of Apple? And it was right around here as it was about to gap up. And I said, I would short the hell out of it. Because look what's happening. As Apple went higher, higher price, the smart money was in fact lower. And this is divergence. Very, very powerful. Someone asked me yesterday in my office, what's divergence? They couldn't understand it. I said, well, imagine this. Imagine you're standing in front of a restaurant trying to get in, and the guy at the door keeps saying, it's closed, it's closed, it's closed. But as he keeps telling you that, 10 people walk in the door, then another 5, then another 15. The whole time he's smiling at you saying it's closed. That's divergence. It's when one thing doesn't really quite add up to the other. And what we're looking for in stocks, if we're buying, is that to happen. It's saying the stock's not going up, the price is staying the same, but at the same time, money flow driving in the back door. In this case, stock was going up, but they were driving out. Price went up, money flow went down. That was the first indication that this thing's going to drop. Your perfect time to short that would be when it gapped up into that same level, created a lower high, and at the same time, a much worse level in money flow. Easy short, from 580 down to 540. And if you're the type of person that likes to play earnings and so forth, here's where you would have bought 520 puts and probably cleaned up ahead of that drop. So there's Apple. Right? Let's look at something else. Let's look at Amazon. Same thing. You had a clear trend line here. We broke down through it, consolidated, but we weren't really consolidating because while price stayed the same, money was coming out the back door. And if you want to go to a longer term time frame, you can see that trend line was broken and came straight down to that support level. Talking about those levels again. DDD 3D Systems, another darling stock, also the same thing. Head and shoulders pattern. As it rallied up into the top of the head and shoulders, we picked this as a short on January 21st. Talked about buying these $70 puts, I think, March puts. I think, and don't quote that, I don't have that in front of me, but I think it was about a 700% increase on those put options on that drop. But even look at the stock. Highly predictable, highly profitable, and you know exactly where that target is, because if you draw the head and shoulders right, you would have seen that you've got this level right here where it came down to. And once again, smart money flooding out as the stock went up. Another example, Joy, emerging markets play. There's your smart money sell zone. Straight up into it. Money flow diverging. Big drop. So all of this stuff combined is where you get the high probability trades. I don't trade because I want another job. Do you? I don't want to sit in front of the computer for 6 hours a day to make money. I trade because I want to enjoy my life. Just like I didn't start a business because I wanted to work in it. You start a business so you can sell it. It's an investment, right? You build it, you create something wonderful, and someone buys it from you. In trading, trading is a business. Trading, your money is your employees, and your strategy is your manager. And as an effective, efficient trader, what you want to be able to do is you want to be able to check in each night, run your scans, and say, okay, based on my business strategy, I want you to do this, buy it here, and if it does this, if it goes up here, sell it. And if it goes down here, get out of it, because that means it's not done what we thought it would. And you put those instructions in, and you let it do it. Now, if you have any stocks that you want me to bring up, feel free to throw them up into the chat box. I've talked a lot about shorts. Here's a long. This is one that I bought 2 weeks ago, Monday, I think, Monday, February 10th. And have a look, smart money going in. Ascending triangle formation, bullish. So I bought it in, I think it was around $6.30 or so. Set my target to $7.43. And I didn't touch it again. Week and a half later, I've made 20%. All right? So these are some of the things that we look at. Again, if you want me to pull something up, I'm more than happy to excuse me, bring up some live stocks. Well, actually, while we're talking about live situations, let's talk about the S&P. Well, actually, no, before we do that, talk about this. Here's another example of something I found yesterday. You know, Dana Holding Company. Trades a few million shares a day, rallying into a strong resistance point. And what do you see? What do you see in the money flow? Money, smart money, same price, lower highs starting to come out. So potential short from 21.50 or so down. Now, this obviously could break out. It could go higher. But, I mean, these are the situations I look for where you've got this high probability where we can take maybe 30 cents of risk for $1.50, $1.60 worth of profit, 6 to 1. So for every one of these trades that goes well, I can take 6 more that go wrong and not lose money. So if I can get it right, it's not a bad stock picker, but I just follow my strategy well. I can get it right half the time and still be doing well and only spend 20, 30 minutes a night doing it. I found this in about 5 minutes yesterday afternoon while doing a training session with a student. Not difficult. As with most things, it's not hard. You just got to do it the right way. You've got to know what you're looking for. You've got to know what the probabilities are. And there's a reason why out of thousands of people around the world in the World Poker Series, there's the same people at the end of the table. It's not because they're just lucky. Yes, luck is involved, but it's because they know the odds. They know what the risk-reward is. And, you know, as the old song goes, they know when to hold them and they know when to fold them. That's why probabilities are king. In the stock market, you have an amazing ability. In poker, you have to pay for your cards. You have to pay what's called the blind. Right? You've got to put money on the table to see what your probabilities are. That's why people lose, because the blinds go up and so forth. In the stock market, you don't have to pay anything to see your probabilities. You get to see your cards every single time before you buy in. And if you know, the problem is you have to know what the cards are. If you know what the cards are, you say, this is an XYZ pattern. The probabilities of this going up is this. The probabilities of it going down is this. When it goes up, this is how much I would generally make. If it goes down, you get my point. And you get that for free. So in the stock market, if you know what your cards probabilities are, you can sit back and wait until you get aces and only play when you do. Now, most people don't know what aces look like. And so without a strategy, they're consistently changing their variables. They're playing the cards they feel lucky. and they have no replicatable method of when they get in, when they get out. And without that replication, you know, they have a big win, but they can't repeat it because they don't know why they won. And when they have a big loss, they don't know why they lost. I had a student once that called me up. He was trading. I taught him how to trade flag formations, and he'd had his first flag lost him money. And he calls me up. He says, "John, I'm really worried because I lost 10% or so on this flag formation. I think I did this wrong and this wrong, so I'm going to do it differently this way. What do you think?" I said, "Why would you change it based on one experience? Have you tested this idea out?" He said, "No, but I lost money on the last time." I said, "So what? You could lose 3 or 4 or 5 times in a row. That doesn't mean it's the bad strategy. It just means it's the market." So he stuck with it, didn't change a thing, and his next 3 trades made him 20, 30%. But most people don't have that tenacity. Most people try and change their strategy every time they have a loss because they think they did something wrong. That's not the stock market. The stock market isn't 100%. You will have losses. The key is, does the strategy work over 1,000 trades? You know, if you take a shortcut on your way to work and one day you get caught behind a garbage truck that delays you 10 minutes, does that mean the shortcut isn't valid? No, it just means you got unlucky one day. So, you know, you've got to be able to know these variables. You've got to be able to track them, test them. And again, I come back to this idea. Even if you do have a strategy, is it being efficient? One of my professors one day asked me, what's the definition of work? Of wealth, rather. 100K a year or 60K working from somewhere else? All right, so we'll move on here. I'll wrap things up. We're coming to the end of our time. But basically the idea is when you know what to look for, you can scan for it. It takes you about 20 minutes a night once you have a scan of what to look for. That's what we do. The way to build this into your strategy is to start to focus on one thing. So January through May are perfect for this. The market conditions are very volatile, as you probably know, typically where we make most of our money. One of the things that we're going to be doing as a special standalone project for today's webinar is we're going to run a 2-hour workshop next week that actually show you how to build these scans out. It's on Thursday, February 27th at 8 p.m. We're going to run about 2 hours, and essentially in this workshop we're going to show you how to scan the market in 15 minutes to look for these high probability trades. We have exact criteria that we use to find this for us, how we become efficient, and also how we're actually going to be using these types of scans to predict big breakdowns in things like Amazon and so forth. Everything we teach you will be in free, will be available using free scans and free available tools. So you don't need to go and buy a new software program or anything like that. We support TC2000, Thinkorswim, Metastock, Incredible Charts, all the big guys, and everything we do you can use in those programs as well as on free available tools that we show you. We'll be talking to you about how to anticipate the market instead of reacting to it, how to build these scans and some of your own ideas using conditions and patterns, how to predict when breakouts versus fakeouts, and a checklist, an Excel document you can take with you that will actually be able to track all this stuff through. So for the $47, it's basically what took me 10,000 hours to figure out. It's the idea is to cut down your time to what's going to make you money. And if we save you 1 hour a month, then the $47 has already paid for itself. So I highly recommend you take a look. We've had a great degree of success over the last few months since doing this workshop, and this will be a special event as a thanks to the MTI crew for having us on. We certainly look forward to seeing you there. I'll pass the mic back over. Thank you so much, Chris, for having us on. I look forward to the next speaker.
Thank you, John, and we definitely appreciate you joining us here today. And you guys, for the link that I sent out to all of you, that is www.acornwealthcorp.com/right. So I just sent that out to everyone. If you guys got that, make sure you do check that out.